We'll start the presentation of the top IRA and 401k mistakes and blunders in about 2 minutes. So, everyone get comfortable, get your notepads ready, and we'll start soon. We're starting the presentation of top IRA and 401k mistakes and blunders in about 30 seconds. So get your notepads ready. Thank you for joining us today for our webinar covering the top IRA and 401k mistakes and blunders many retirees or soon-to-be retirees make. I'm honored to introduce your presenter today, Tim Wood, founder and owner of the Plan Advisor, which serves the retirement needs of clients nationwide. His company was founded on the ideal of education first, which is one of the reasons Tim became a certified financial fiduciary. As a fiduciary, he always puts the client's needs first in all situations and is completely independent, not answering to any insurance company. He is also the host of the weekly on-air radio show and podcast, Safe Money Retirement Radio, where he is able to use his years of experience to educate retirees about ways to protect their hard-earned retirement dollars from losses. He also shares his knowledge as an invited author on Think Advisor, where he helps other advisors nationwide grow their practice and make the best decisions for their clients. Ladies and gentlemen, here is Tim Wood.
Thank you so much, Jimmy, for that great introduction. Good evening, everyone, and welcome to our top IRA and 401k mistakes and blunders webinar this evening. Very happy. It looks like a very full room this evening. Let me look real quick and see. I'm seeing Texas, Michigan, Virginia, North Carolina, Florida, Massachusetts, Nebraska. Seeing literally all over the place there's people from. So welcome, everyone. Hope we can get a lot of your questions answered this evening. We're going to go through a lot of information and a lot of the pitfalls many retirees face when it comes to their IRAs and 401ks during this webinar. So get your notepads ready and let's jump in. But first, I want to mention, you'll see there's a chat feature right here. If you would, at some point here in the next few minutes, go ahead and chat me what your number one question about your retirement or your IRA or 401k or RMDs or any of that stuff is. I've got it set to private. Nobody's going to see it but me. That way, at the end, I've got about 5 or 10 minutes built in. I'll go through and get those questions answered for y'all. So if you can, just go ahead and get that before we really get going. All right. First, I want to start with a personal story that I'm sure many of you have heard many times over the years. And if you've seen any of my other webinars, you've certainly heard this before, but it's important. This is my dad, Leon, back in the early 80s. He's a great man, a very hard worker that always provided for his family by working his tail off. Now, like many of you, he worked for many years for a company and wound up with a substantial amount of stock he was planning on using to help fund his and my mom's retirement. Well, here's what happened. After working all those years, he finally got to retirement and was ready to put all of that stock to work for him in retirement. But within 4 years of leaving that company, 4 years, the value of all that stock he had accumulated over the years had dropped by over 75%. That's 3/4 of his retirement savings gone because of market volatility. And we're not talking about a small amount here. I'm not going to talk about dollars, but we're talking in the six figures he lost in less than 4 years. So helping people protect what they've worked their whole lives for is personal to me. I mean, it's affected my family. I've seen the effect a market downturn can have on someone's retirement firsthand. So I've made it my goal to help as many as I possibly can to protect their retirement savings from market losses. Now, many people ask me, what are your typical clients like? Who do you work with? Well, the short answer is I work with conservative investors mostly. The clients we love working with spend a lifetime taking risks. And now that they're at the point in life where they're saying, you know what? I took all the risks I needed to live the life I want. Now, all they want to do is the things that they enjoy. They do not want a portfolio dictating to them how they should live life. They want to dictate how they should live because at the end of the day, it's all about lifestyle, isn't it? Now, today's event is live, so let's get through some housekeeping real quick before we really jump in. I encourage you to stay focused. That means not answering any phone calls, Xing out of any other tabs or programs you may have open. And because this is a live event this evening, you're going to have an opportunity to ask questions in the chat feature, like I mentioned a minute ago. Now, I encourage you to type in whatever and however many questions you have. Towards the end of the workshop, I will take as much time as I can before they cut me off and answer as many questions as I possibly can. And if you stay until the end of the workshop, you'll actually receive a very special offer. It's going to be a complimentary, personalized 401k and IRA analysis that's personalized just for you. It's going to be complimentary. So stay tuned and we'll make sure we talk about that. Now, let's get into today's subject, which is the top IRA and 401k mistakes and blunders that I've come across. Now, I compiled some of the things my team has seen through all the years of being in the industry, what we've seen clients go through, and what I want you to learn so you don't make these mistakes and blunders that can cost you so much money in the future. Now, let's start with a brief look at the history of retirement plans in America. This all started back on August 14th of 1935. This is when President Roosevelt signed the Social Security Act. Now, when he put this in place, this was meant to supplement personal savings, not to replace them. Way back then, the average person would retire and die about 4 years later. That's something to look forward to, isn't it? Because the average life expectancy at that time was only 64 years old, and people were working to 60. They weren't expecting this to take care of people for 25 or 30 years in retirement. What happened is that government wanted us to lessen our dependency on them. So in 1974, Congress passed the ERISA laws, which gave birth to IRAs and 401ks. The purpose of this was to give Americans more incentive to plan for their retirement. Now, someone back then looked in the future and said, listen, with all these baby boomers and everything that's happening, there's no way this country is going to be able to handle and supplement everybody's retirement. Now, they did offer incentives. They gave us tax deductions on contributions. They gave us tax deferral on gains. They gave us payroll deduction. They gave us exemptions. But of course, this all comes at a price. There's always a catch. Taxes and penalties. All distributions are fully income taxable. There's a 10% penalty for early withdrawals prior to age 59 and a half. So you don't want to do that before 59 and a half unless it's an absolute emergency. And then the granddaddy of them all, a 50% penalty, 50% penalty if you fail to take your RMD distributions at age 72. So that takes us to our first mistake and blunder, which is not understanding how the Secure Act of 2019 impacts your retirement accounts. So let's talk about that. The Secure Act of 2019 came into existence in December of 2019 and was effective January 1st of 2020. Now, this was our first piece of major legislation that we've had in over a decade when it comes to our retirement. Now, the first thing it did for us was gave us new rules for IRA owners. Now, the rules are as follows. It eliminated the 70 and a half age limit from making traditional IRA contributions. This means you can contribute longer. It also increased the age to start taking RMDs, or required minimum distributions, from 70 and a half to 72. So now we can wait longer to take out distributions. Then it made some real big changes to our beneficiaries. The old rule was that children and grandchildren could spread their distributions and taxation over their entire lifetime, but they did away with that. The writing's on the wall, and we all know the government wants their taxes and they want them paid sooner and not spread out. So here's the new rule in effect now. Children, grandchildren, and all other non-spousal beneficiaries must pay taxes no later than 10 years after they inherit. So again, the new rule is all non-spousal beneficiaries must pay the taxes due on a traditional IRA or 401k inheritance within 10 years. That's the new rule. Now, what are the options for the beneficiaries once that happens? Here's their options. They can liquidate the account immediately and pay all the taxes due. They can spread the distributions and taxes out over the 10 years, kind of like a pay-as-you-go. And that's typically what I advise my clients to do. You know, when someone has passed and they get something like this coming in, that's what I typically suggest they do, is spread it out over 10 years so they're not impacting, getting a huge tax hit either right then or the last option, which is wait 10 years and take the distribution out as a lump sum at the end. Either way of the lump sums, you're getting a huge hunk because that goes towards regular income on your W-2. So that can really kick someone up in a tax level. Okay, these new rules, along with proper planning, can help ensure your lifestyle during your retirement years. It's so important to understand how these new rules are going to affect not only yourself and your spouse, but also your legacy. And when we do your IRA and 401k analysis, we can make sure that you are set up and everything is right for all of your beneficiaries. Okay? All right, mistake and blunder number 2. Now, here's where we see all kinds of stuff happening, and it comes down to beneficiary designation. Something a lot of people don't think about, but pay attention to this. This is important. Most people think, man, it's so easy. All you have to do is put a name in there, and that's who's going to get it and who's not going to get it, right? But there's so many things that come with beneficiary designations, and we all know the government does not make anything easy for us, right? We all know that. All right, the Kennedy versus Plan Administrator for DuPont Savings and Investment Plan ruling is one of the most landmark decisions made in the last 50 years when it comes to IRA and 401k retirement plan beneficiaries. The ruling says that the beneficiary form trumps everything, regardless of what a will, a trust, a divorce decree, or any other signed document says. Now, I'm gonna give you guys a few stories this evening because I think it's a really good way to share this information. I had a lady that came into my office a while back who shared this with me. She had been married about 15 years to her husband who passed away. Well, when it came time for her to request the proceeds from his IRA, they told her she couldn't have them. She said, why? It's in our trust that anything that was his would come down to me. But in this case, this was both of their second marriages. And he forgot to change his beneficiary to her from his ex-wife. So what happened? His ex-spouse was still the beneficiary listed on all his documents for his IRAs. So when he passed away, the money didn't go to his current spouse of 15 years. It went to his ex-spouse, and she kept it all too. Imagine how this made her feel. I mean, she was furious, as you can imagine. But this is what happens when we don't understand proper beneficiary documentation. So many people make mistakes on this. When we have a properly set up beneficiary document, it prevents losses due to cost and time of probate, disinheriting grandchildren, bankruptcy, and divorce. This is why it's so important to get beneficiary checkups. You get a medical checkup every year. You should get a beneficiary checkup at least every couple of years. Just because things are changing so quickly, you want to make sure your beneficiary designations are up to date. And this is something that I would make a note to do immediately because you never know when a life event's going to happen. Make sure your beneficiary designations are correct in your accounts. Once again, that's something that we can look at when we do your personal IRA and 401k analysis. We can make sure of that for you. All right, let's keep rolling here. Mistake and blunder number 3. Now, not knowing this one can really cause you some havoc. Not understanding the rules for rollovers can cause you immediate taxation, and it can be dramatic. Now, there's only two ways to transfer your IRAs and 401ks. Number 1 is a direct rollover, and number 2 is an indirect rollover. So let's look at these. Let's look at direct rollovers first. This is transferred directly from one institution to another. That means whoever has your IRA or your 401k or whatever it is, 403b, 457, TSP, whatever, it's sent directly from them directly to the other company. You do not receive a check. Again, it's sent from one institution directly to what they call a new custodial. So it's sent directly. You don't touch that money. You can do these as often as you want without any tax consequences whatsoever. And if it's a 401k, there's no 20% mandatory withholding. Now, keep that in mind while we look at number 2, the indirect rollover. Now, here's where the big changes were made. We used to be able to do a 60-day rollover as many times as we wanted to, just like we could with the direct rollovers. But they changed the rules. Why? Because so many people were making mistakes, and many times, as you know, the government profits from our mistakes. Because now the rules are your funds will go from your current company directly to you, then you have 60 days to roll that over. So in an indirect rollover, that check is made to you. You then have a 60-day deadline imposed on you from the time that you get that check to the time you roll it over. Here's where they get you. Only one indirect rollover every 365 days. Now, that's not once a year. It's every 365 days, and that's important. Additional indirect rollovers in the same 365 days are 100% taxable. And if it's a 401k, it comes with 20% tax withholding. And here's another story. I told you I was going to tell you a few of these. I had a client referred to me last year. Now, what happened to him was he bought some property in North Carolina and wanted to make some renovations. He was going to turn it into an Airbnb or something like that. He had a small IRA and wanted to use that instead of taking out a loan from the bank because he just needed quick money that he could put right back in. So he decided to use the 60-day rollover, use that money, and then put it right back. No harm, no foul, right? Well, he did that on a $35,000 IRA. No problem. Well, 4 months later, they needed more money to do even more renovating. They wanted to add more stuff. So he used one of his other IRAs that had about $235,000 in it. Within 60 days, he put it back. No worries, right? He did it. Then in January the following year came the shocker. He had a 1099 for $235,000, 100% taxable. And there was nothing he could do about it because you can only do one indirect rollover every 365 days. If you did one on June 1st, you cannot do another indirect rollover until June 1st of the following year. If done prior to that, it will cause immediate taxation at ordinary income rates. Now, don't let this happen to you. Okay, let's keep rolling. Mistake and blunder number 4, Roth conversions. I call it the seed versus the crop. Let me explain. From the first day you and I contributed to a retirement plan, we made a deal with the devil. Now, I want you to really think about this I'm about to say. You know, the government only does a few things that are in our favor, right? Now, they understood way back then that most people take all of these benefits we spoke about earlier, such as not paying taxes right away, the deferral, and all that stuff that comes with it, and everyone looks at it and is like, wow, this is great. But is it? Here, imagine I was a mortgage broker when you bought your first home, and I came to you and I said, listen, we're going to fund your home, you're approved, but as far as an interest rate, I'm not going to decide that today. Let's wait until your loan is due in 30 years. Then, whatever the interest rate is then, I'm going to apply that rate to your loan back to day one. Does that sound good? Would any of you ever take that loan? I sure know I wouldn't. Most of you would say absolutely not. But that's exactly what we said with these IRAs. We said, I don't care what the tax rates are going to be in the future. I just want these benefits now. And the government knew we'd do that. They also knew the government was going to grow. That's why I call it the seed and the harvest. This is why we're so adamant about speaking about Roth conversion IRAs. We are in the lowest tax bracket right now that we will probably ever see again. Historic lows, actually. Think of all the money going into the system right now. All the stimulus money, all the paychecks going out, inflation coming. What do you think that's going to do to taxes? Now, when I do live events, like remember we used to actually get together, with other humans. When I used to do that, I'd always ask people whether they feel tax rates are going up or going down in the next 10 or 20 years. And pretty much almost unanimous, I got almost 100% yes every single time that rates have to go higher to cover all our crazy spending here and abroad. But all we know with 100% certainty is where we are today, right now. We have no idea where tax brackets are going to be in 10, 15, 20, 25 years in the future. I believe we're probably at the lowest tax brackets we will ever see. But my crystal ball is broken. It's actually in the shop. So we'll have to just wait and see what happens. But this is why we say pay income tax on the seed, and that means do it now. Start looking at conversions and see if they make any sense. Pay the income tax now when you know the rate. And when you do this, all distributions and gains in the future are income tax free. You want to get the government out of your business? This is where it starts, understanding these Roth conversions. Enjoy your harvest tax-free. And there are products out there that allow you to move as much as you want over every single year. So some years you can move none over, some years you can move a lot over, depending on where your income falls on the tax bracket. I can help you with that, help you come up with a plan for that when we do your analysis. Okay, let's keep rolling here. Now, any of these Roth conversions must be done properly, because guess what? Once you do a Roth conversion, now, unlike how it used to be, they changed these laws too. There is no more what they used to call recharacterization. Now, what that means is, in the past, when we ran the numbers and it didn't work out, like when you did your taxes, we could recharacterize. It was kind of like a mulligan for those of you that golf. It's like it never happened. Just do it again. Well, that went away too. Now, once it's done, it's done. It's like deciding when to start taking Social Security. You have to live with that decision forever. So it's very important that you work with someone that understands the conversion process and understands what it means and what it means specifically to you. You need to make sure it's real. It really works for you and it makes sense. I mean, because it doesn't for everybody and in every situation. Because at the end of the day, it's your money. It's not theirs. All right, keep rolling. Mistake and blunder number 5, missing a required minimum distribution. Boy, this can be a rough one too. For those of you that have been in my RMD webinars, you've heard me talk about this. All right, let's get into RMDs real quick. Your first distribution is due by April 1st of the year after you turn age 72. Because the Secure Act we discussed earlier moved the age from 70 and a half to 72. So it's 72 now. All future distributions are due by December 31st. And of course, missed distribution causes a 50% excise tax. 50%. This is the number one mistake IRA owners make, and it's the biggest penalty levied on any taxpayer in this country, and people do it over and over and over again. RMDs are full of gotchas. For example, if you don't take out what you're supposed to, let's say it's $10,000 and you missed it, you'll have to pay an excise penalty tax on an additional $5,000 plus the original taxes and penalties, which actually takes you past 50% and puts you closer to a 75% penalty. So make sure you understand required minimum distributions and how they affect your specific situation. Once again, this is something that we can go over in your analysis and make sure you're set properly for your RMDs. The other thing people don't understand when it comes to RMDs is not understanding how RMDs work with 401ks. The reason why I bring this up is because I run across so many people that still have 401ks, IRAs, and RMDs, but they don't understand the rules because there's a huge gotcha in this, and the government knows it. They're waiting for you to make this mistake. So don't. Here it is. Why? Because they want their tax dollar, obviously. So let's look at another example. This is a 72-year-old with $1 million in savings. I'm just going to use that because it's a nice, easy round number to work with. Now we're going to say he has $500,000 in IRAs. So his RMDs are going to be approximately $20,000. Once again, we're going to use round numbers. Approximately $20,000 is what his RMDs are going to be. Let's assume he has 2 IRAs, like you can see here on the screen. Now in retirement, when you have IRAs, the government doesn't care where you get that $20,000. They just want you to take out $20,000 so they get their taxes on it. You can take out $10,000 from one, $10,000 from another, $5,000 from one, $15,000 from the other, all $20,000 from one, commingle all of it. They don't care when it's from an IRA. However, when you have 401ks, now we have to be careful. Here's where they get you. Now he's got his other $500,000 here. He's got a 401k and a 403b. Now there's RMDs on those, same 20,000, the amount doesn't change, but you cannot commingle IRAs or 401ks, or I mean, you can't even combine 401ks of any kind, 403bs, 457s. You can't combine any of that stuff. They each carry their own separate RMD. So this individual here has 40,000 total RMDs from the entire million. But if he took 40,000 from his IRA on the left side of the screen, the government is going to come back and say, hey, you still have $20,000 in RMDs due on your 401k and your 403b. So now that's a penalty of 50%, an additional 20,000 on there. What the government has done basically is build a firewall between IRAs and 401ks. This is why I tell my clients, once you get into the distribution phase of retirement, where you're taking distributions from your money instead of just growing it, you should bring everything under an IRA umbrella so you can control the distribution, since you cannot commingle IRAs, 401ks, 403bs, 457s, TSPs, yada, 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 all that. They must be treated independently and separately. Okay, now let's just review that real quick because that's very important. Accounts whose RMDs must be calculated and taken separately include 401ks, 457s, and 403bs, and several other, I mean, there's other out there. And the only type of account you can commingle and put together is your IRA. That's it. Again, when you get to this stage in life, start bringing everything together under the IRA umbrella. It just makes life so much easier and puts you in control of your money. Okay. Something else that's really important, another very important slide. If you're dozing off, pay attention. Okay. RMDs, once again, are required for this year. They went away for last year for 2020, but they're back for this year. So don't miss them, because if you do, they will hit you with that 50% excise tax. Do not let that happen to you. If you've got questions, we can talk about it in your analysis. Okay. Mistake and blunder number 6, not rolling 401ks, 403bs, TSPs, 457s, all of that stuff to personal IRAs. Now, once you retire, you can either leave the money in the plan or roll the plan to an IRA. Again, if you want to take control of the assets, you want to be able to control everything about the distribution of your assets. And you can only do that if you have everything under the IRA umbrella. Now, for those of you that are still working, as long as you're over 59 and a half, there is such a thing called in-service non-hardship distributions. More and more companies are allowing you to take these in-service non-hardship distributions. I would say at this point, probably about 75 to 80% of companies I'm seeing retirees ask are saying that, yes, you can do this. What it means is you can start taking money out of your 401k and transferring it directly to your IRA so that you can start taking control of those assets. You don't have to wait until you retire. At the end of the day, with proper planning, you can ensure a lifestyle for yourself and a legacy for your family. All right, now here's where things start getting really serious. This goes back to the story about my dad. This is one of the things that we just don't think about, but that I see on a daily basis when I meet new people online here or in my office locally. And that's mistake and blunder number 7, not understanding volatility in your portfolio and what it can do. Volatility is the enemy of income. I'm going to show you what I mean. All right, for those of you that do not want to outlive your money and want to provide for your heirs or both, you have to understand that volatility can ruin your plans. Now, why do I say this? Let's look at what's going on now. This is a couple of months old. This is back in July 6th of 2021. I actually need to update this slide, but it's still pretty doggone close to this right now. I want you to direct your eyes right here to the Shiller PE ratio. As of July the 6th this year, that number was sitting at 37.99. Now, the median average is sitting at 15.83. This is your price in earnings, okay? In a good economy, your Shiller PE ratio is somewhere around 15. Yet right now, or just a couple months ago, we were sitting at 37.99. Now, when all heck broke loose in December of 99, we were at 44. Now, think about that for a minute. Why is this important? Because you're either close to retirement or you're already in retirement. So this stuff probably didn't matter to you when you were working because you were accumulating, you were taking risks. We all needed to. That's how we got where we are today. But now it's time to start taking your money. It's time to move into that phase where you're distributing your money. And the landscape is telling us it's not really in our favor. Let's look at the total market capitalization versus the gross domestic product. It's sitting at 205.3% as of July. Now, anything above 135% indicates that the market is significantly overvalued. And most of us know that, but we still buy volatile stocks all day. Why? Because the government is spending an enormous amount of money in stimulus and keeping the interest rates artificially depressed. But we all know there's going to be a reckoning. Remember the game Musical Chairs? That's kind of like what's happening right now. When the music stops, are you going to be left without a chair? You know what all this is saying? Proceed with caution. All right, let's move on to mistake and blunder number 8 this evening. Not understanding the history of the market. Now, how many of you out there believe that history has a way of repeating itself? Because I know I sure do. I've seen it. I remember when I was young, I used to say, man, I am never going to say what my parents said to me to my kids when I get older. There's no way I'm going to tell my kids that. Not going to happen. Then the first time I said something that my parents said to me, to my daughter, I said, oh my goodness, sound just like my dad. Because you know what? History has a way of repeating itself. The problem is that we as individuals refuse to learn from it. So let's look at the market. Understanding historical returns and market volatility is so important because everybody talks averages. The average return for the market right now is between 8 and 10%, but that's an average. For example, I can tell you that my wife and I run an average of 10 miles per week. Pretty good, right? But the truth could be that my wife runs 20 and I run 0, but our average is still 10. Now, did I lie to you? Absolutely not. But I certainly didn't tell you the whole truth, did I? That's what happens when we talk averages. Now let's look at this, okay? This is January 2000 to January 2013. This is the actual S&P ticker. In January of 2000, it was sitting at 1469. It did not get back to 1469 until January of 2013. So it actually equals a 0% return for 13 years. We were down about 50% in 03, went almost all the way back up in 07, lost even more between 8 and 9. I'm sure a lot of you remember 8 and 9. That was rough for a lot of people. I've got a lot of clients that lost 50% of their portfolio within months. And then it started to go back up again. But if you had retired in 2000, you would have gotten 0 in return all the way to 2013. That means you would have had to start cannibalizing your principal, and you would have already been in disaster mode, worried about running out of money. Now, what do you hear from many brokers? They'll say, write it out, you got plenty of time, and they'll tell you it's not important. Now, writing it out while you're working is okay. We've had to write out. We wrote out, 2003. We wrote out 2008, 9, and before. But when you're at retirement, it matters big time. From 2000 to today, the annualized return for the S&P 500 is 5.146%. So they're telling you to risk all of your money for 5.1%. Now, I don't know about you, but if I'm going to take a risk and go big, it's certainly not going to be for 5%. You know why this is so important? So many people look at retirement in little blocks. They look at 1 year, 1 year, 1 year. No, you need to look at retirement as larger blocks of time. 10 years, 20 years, even 30 years. Most retirements now are between 20 and 30 years. So when we're actually trying to look into the future, we have to look at history and ask, what did large segments of the market do? We all know history is a strong predictor of what the future can hold for us. This is why understanding historical returns and market volatility is so important. Now, this leads us right into our next mistake and blunder, which is mistake and blunder number 9, chasing higher returns in retirement. Everybody says, no, the market, you have to be in the market. And again, that works when you're accumulating. But when you start taking money out, things change. Here's what's going to start happening. There's 2 ways of taking money out. The first way is engineered retirement income. I actually call it the if-come method. Some of you I can see in here have met with me before. You've heard me call it this because it's if the market has performed and if things go well, then I might have money. Let's look at this individual right here on the screen. We're going to continue to use that $1 million since it's an easy number to work with. This person has $1 million and they're going to follow the 4% rule. I'm sure many of you have heard that over the years. So they want that 40,000, that's 4% in income, and they started taking that out. Now, what you're looking at is the actual S&P from 2000 to 2019. And what happened here is that at the end of those years, he went from $1 million to $345,000. Almost 2/3 of his money was lost. And why was it lost? It was lost because of this. 5 bad years took away. And why was it lost? This is why, if you're following the market, thinking that the market is going to support you in retirement, you could be in serious trouble because the rules change once you start taking distribution. When you're taking distributions in bad years, it can be a real disaster for your total cash outlook. Now, the average rate of return was 5.146%, but the ending account balance in 2019 was $345,000. Now, how is that possible? Those of you that have a math mind, I'm sure right now you're trying to figure that out. The reason? They didn't tell you the truth behind the numbers. Let me give you another example. Imagine you had $100,000 in the market and there's a downturn and you lose 20%. Simple math puts you at $80,000, right? Real simple. Now, most people think, okay, well, if it goes down 20%, it'll rebound 20% and I'll be fine. Will you? Let's do the math on that. If you're at 80% and you get a 20% gain on 80, or if you're at 80,000, not 80%, and you get a 20% gain on 80,000, where does that put you? Doesn't put you back to 100, does it? Puts you at 96,000, not back to your original 100. Now multiply that over and over again and with bigger and bigger numbers, and you can see how volatility can kill your account value, especially in the distribution phase. Now, the second way of taking income is something I call the true income method. It's just one of the methods I work with my clients with and that we talk about during your analysis. The individual has the same $1 million. That hasn't changed. They still want to take the $40,000 out and they want to keep their principal at $1 million. Now, what you have here is they have a simple interest account or dividends coming in at 4%. And they didn't cannibalize their principal. You can see at the end of the 20 years, they still have their $1 million. Again, it's not what you make in retirement, it's more what you keep. That's what's going to fuel your lifestyle. With a return rate of only 4%, we still have our $1 million right there. Now, how can you average 1.8% more than 4% and wind up with $345,000 by the end of 2019? Ready? Volatility. Volatility kills income. It changes once you start getting into the distribution phase. Volatility kills income. You've got to ask yourself, does it really benefit you to chase returns during the retirement or distribution phase like it did when you were accruing? Now, answer this. What's more important? Is it more important to eliminate volatility or chase higher returns? Again, at the end of the day, good advice is what's going to make the difference between an erosion of income and a lifetime of income. So make sure the advice you're following is solid and secure. All right, let's get into that special offer, the IRA and 401k analysis. Now, in this analysis, we're going to take a look at multiple things that are specific to your situation. We're going to find out what is really going on in your IRAs right now, in your 401ks, and your TSP plans, and your 457, whatever you've got. We're going to find out what are your possibilities for conversions. Would it make sense for you to do a Roth? Does that make any sense? And how would you want to structure that? How's taxation going to affect you? Are you ready for RMDs? We're going to talk about all that stuff and how everything comes together. Now, many times advisors charge up to $1,200 for one consultation and to do a custom analysis, but I'm actually going to offer it to you absolutely free of charge. Okay. I actually had a lady, I think it was about 4 or 5 webinars ago now, that went to a very popular radio host's website to apply for one of these. And she got an email back. It was going to be $5,000 for one analysis. Anyway, I'm going to do this absolutely no charge. In the next few moments, you'll have the opportunity to schedule a time with me to do your review. And all you have to do is schedule your analysis now and not change the date and time. And this offer will remain complimentary. Okay? It's our way of thanking you for watching this whole webinar and to help you get the absolute most you can out of your retirement. So I am going to go ahead and launch this right now. And there it comes, right there on your screen. So that should have just popped up. It's very simple. All you've got to do is click on that. It's going to open up my calendar. Just click a time that's going to work for you. Put in your name, your phone number. You can set it up however you want. We can do a phone call if you'd like. That's fine. And for some people, that's their favorite thing. That's fine. If you're good with doing a Zoom, which I'm assuming you probably are because you're on a webinar, I'd much rather do a Zoom so we can talk face to face and get a little bit of conversation going. So it's very simple. Just click that box, set up the time that's going to work for you. We'll get together, we'll talk. There's no obligation whatsoever in any way, shape, or form. We're just going to look and see where you're at, what your options are, and I'll make sure that you get all of your options. One other thing, if anybody, I have got a book called Safe Money. Talks about all of these products and how you can protect your retirement dollars once you're in retirement. If anybody would like a copy of the Safe Money book, I will send you a copy, absolutely no charge. Once again, no obligation, just as a way to help you get your education. So if anyone has any questions about any of that, let me know. Okay. Let me go ahead and jump in here. I know I have had quite a few questions come in. So let me just start answering some of them while y'all are still scheduling. That's still going to be open there for a while. So as I'm answering questions, just go ahead and get yourself scheduled. And then if you've got a question that hasn't been answered yet, go ahead and go on to the chat. Once again, it's private and nobody else is going to see it. I'm the only one that's going to see it, but I've got about, let's see, how long do I have? I got about 9 minutes. So I should be able to get through at least a few questions here, and I've already got a few. So if you've got one you want, make sure you get it typed in now. All right, let's go ahead and start. RMD taxes, conversions to Roths. Well, that's all it says. RMD taxes, conversions to Roths. If you could give me more of a question, yes, that's not, I don't really know what you're asking there. Yes, RMDs, you've got to pay taxes on your RMDs when you pull the RMDs out. Conversions to Roths, that does make sense in some cases. Once again, there are products out there that you can put your, what they call qualified dollars, which is just pre-tax dollars. That's all that is. You can put it into a product that would allow you to convert whatever amount you wanted to on an annual basis, and you can convert different amounts. So, there are products. Once again, I'm not sure what your question is, but there are products out there that you can put your money into that will allow you to convert it in the same product, same account number. You're not having to move products and all that stuff. Same account, you can move over to a Roth every single year, however much you want to. So I'm not sure if that answers your question. If you could just chat back and give me a little bit better. If that's not an answer to your question, let me know and I'll come back to you. Okay, let's go to the next one. Should I keep putting money more in my Roth than 401k? Well, once again, that's going to be, I can't just give you a blanket answer. That's going to be something that we certainly could look at when we do your personalized analysis, maybe. Now, as far as contributing and transferring, when we're talking about Roths, two totally different things. Contributing is what's coming out from your employer, contributing to that account. Roth right now for this year, the max you can contribute is 19.5. Unless you haven't contributed before, then you can do a few thousand more because of catch up. But we're just going to say 19.5 is the max, typically for contributions. For transfers, there is no max. So yes, maybe it might make more sense just to go ahead and transfer your 401k into a product that would allow you to move as much as you wanted over to a Roth every single year in a transfer. And then you could determine how much you wanted to move over. And I don't want to get too far down the road and too deep into the weeds because I've got more questions here. But that's something that we can look at in your analysis. We can look to see exactly where you would fall on the tax brackets. Because remember, anything that comes out of your qualified funds and would go into Roth, they are going to tax it like regular income on your W-2. So that would be what we would actually look at. We would look and see where you fall on those tax brackets, so we can see exactly, how much you could do without it kicking you up to the next tax level. Does that make sense? Okay. Hopefully it does. If not, please keep asking questions. Someone looks like having problems getting to the calendar. Yes, I can. If you continue to have a problem, if anyone else is having a problem, send me a message. But yes, I can absolutely email you a link. And if anyone is having a problem here, you can go right to my website, which is theplanadvisor.com. Real simple, name of my company.com, theplanadvisor.com. And you can see a place to schedule an appointment, and there's a place right there for IRA, 401k, and RMD analysis. So if for some reason this isn't working for you, go right to my website, theplanadvisor.com, go to schedule appointment and click on IRA, 401k, and RMD analysis, and you can schedule it right there. Okay. All right. Let's see what else we got here. Let me open up this other window here. Chat. All right. I want to know the safest way to transfer money over. What I mean is the safest way to protect what I've saved, the safest way to protect what I've saved for my retirement moving forward. Okay, I think I understand what you're trying to say there. Basically, I think what you're trying to say is there are products out there that basically you could transfer, their IRA products, that you could transfer your 401k, your TSP, your 457, whatever, 403b, any of that stuff. You could transfer in, and these products actually will still give you a portion of the gains when the index is up, but guarantees you no losses at all ever if the index goes down. So that might be what you're talking about, is there are products out there, and they're IRA products, that you can get a portion of the gains when the market's up and none of the losses when the market goes down. They're called point-to-point indexing products. Actually, I tell you what I could do real quick here. 1 second. I've actually got that pulled up. I get this question a lot. So real quick, this will take 2 minutes. I get this question a lot, so I've actually normally got this prepared. So let me do this real fast. Just this will take 2 minutes. Here's how these products work, because I've got that question and more of you may have it. How these work is, this is, once again, this is that same S&P from 2000 to 2013 that we were just looking at 10 minutes ago. How these products work is they literally just work on a point-to-point basis, okay? So what we're going to say is, we're going to say you started, for purposes of this illustration, you started in 2001. Let's just say you had $100,000, and this green arrow here is your $100,000, okay? Now, this product only looks on a point-to-point basis. And at the end of each crediting period, which in this case is a year, most of them are 12 months, only 2 things can happen. Number one, if it's down, you stay exactly where you are. So in this case, you can see from 01 to 02, if they were on the S&P 500, you can see that it went down, obviously, down. But you stay right where you are. You don't get credited anything, but you don't lose anything. You can see the next year from 02 to 03, it's down even further. Once again, you're still right here with your $100. Everybody else is freaking out because they've now lost 50% of their value if they were in the S&P 500 traditionally. You're still at your 100,000. But here's the secret sauce. The next 12 months, once again, these are just point-to-point products. They don't care what happened before. They don't care what's going to happen later. So in this case, this point-to-point, you can see it's up. You get a percentage of those gains. And there are products out there, I can prove this to any of you, that will give you 90% of those gains with no fees. None. Zero. Absolutely none. No chances of losses, and 90% of the gains when they go up. I can prove that. Every year that there's a gain, your money gains. So here by 08, when everyone else is thinking, oh, thank God, I'm finally almost back to even, you're way up here. Then what happened? 09. Bam. We remember that. Now everyone's really freaking out. It's even lower than it was in 03. You know, people are completely stressed and they're really cannibalizing their principal. You still stay right here because, once again, only 2 things can happen. You stay where you are if the index is down. You get a percentage of the gains if the index is up. That's it. There are no other options. Every year that it's up, you get a gain, and it's point to point. So you can see right here between 9 and 10, it goes down and then back up. Doesn't matter. It could have gone down and up 800 times. It's point to point. Point to point, it's up, so you get a gain. Every time it's up, you get a gain. What this means to you, your principal stays 100% safe. All right. That's how those products work. Hopefully that's kind of a long answer to answer that question, but hopefully that answered that question for you. Hopefully that answered that question for you. Okay, let's see where we are on time. I've got 1 minute. Let's see how many more questions do I have. Oh my goodness. Okay, that's someone just asking for the book. I will take care of that for you. That's not a problem. Absolutely. Let's see, what else do I have? I've got another question right here. How do I know what is in the accounts that I have? I've had accounts at my current job for over 23 years, but I don't know exactly what it is. Well, you need to know what it is for sure. One thing I can say is you should be getting quarterly statements at least. If not monthly, you should at least be getting quarterly statements. In those quarterly statements, it's going to show you exactly what you've got. And that would be what we would need when we do your analysis, so we can figure out exactly what you've got, figure out exactly what your options are, and then basically just show you what your options are. Let me just real quick divert just so I can explain real quick. I know it said at the beginning I'm a certified financial fiduciary, and I am. I'm very proud of that, and I take that very seriously. And what it means is two things for you. Number one, it means I only work for you. I do not work for any insurance company. I don't care what you go with. I'm completely independent. What I'm going to do is I'm literally going to show you every option that's available for you in your state for whatever your situation is. Number two, it also means I have a set of what they call protocols in the fiduciary world. It just means a set way that I do business every single time. So the first thing that we do is what I call a fact finder meeting. It's just a very simple meeting. It's actually the analysis that we're talking about, where we just look and see exactly where you are, what you've got, what the implications are for taxing, and exactly what you want to happen. Do you want it to turn into a guaranteed income you can't outlive, kind of like pensions? Those of you that remember pensions, there are products out there that are basically like pensions, that you can take your 401k or IRA or whatever, move it into a product, and it will pay you a guaranteed amount every year. The further you defer that out, it's got a guaranteed roll-up rate, so it's going to get more and more every year, kind of like Social Security. There's also products out there like what I just talked about that you can just grow and let it grow. But I don't know what product is going to work for you until we figure out what you're wanting to do. So that's why we do this analysis, figure out what you want to do. Then I've got a team that will basically search your whole state, figure out exactly what your best options are, and then I will come back to you. We'd schedule a meeting just like this, but it'd be one-on-one, and I'll say, okay, here's what my team found. Here's 1, 2, 3 options. Here's how it would work. Here's the company. Here's everything about it. And then it's up to you what you want to do. If there's something that you want to do, I'll help you do it. If it's not, great. Now you know what your options are. You can move forward. The one thing I would recommend for sure, big time, is no matter what, whether you do business with me or not, it's fine. Make sure you're doing business with a certified financial fiduciary. If you don't know what that is, search for it. You can go to the Association of Certified Financial Fiduciaries, search for me. You'll find me. I'm in there. It's very important, and it's a lot. It's quite extensive. It's quite a bit in order to get that certification. But it means that someone is really going to devote their time and energy to work for you specifically. Let's see, I am really over on time. So let's see. I think I pretty much answered most of all of the other questions. If I didn't, I apologize once again. If I did not get to your question, I'm sorry, I run out of time. We can go over it in your analysis. Once again, if anyone accidentally closed that or it didn't work, you can go right to my website and just go to theplanadvisor.com, and you can go ahead and go to the schedule appointment page right there, schedule a 401k, IRA, and RMD analysis right from that web page. Because I want to make sure everyone gets their questions answered for their specific situation. Okay, because everyone's situation obviously is different, right? We all know that. So, all right, let's go ahead and wrap this up for the evening. I want to thank everyone for watching this webinar. I sure hope I answered most, if not all of your questions. If you have any more, please contact me directly, or we can talk during your analysis and figure out exactly what it is. You can reach me anytime at theplanadvisor.com. There, you can contact me right from there. You can schedule an appointment right from there. There's chat right on that website that you can just chat. There's a ton of resources. I mean, there's literally dozens of videos, hundreds of articles. If you listen to podcasts, I've also got a podcast that's called Safe Money Retirement Radio. You can search for it. Literally, it's on every single platform that there is: Apple, the iTunes, Amazon, Google, Spotify, pretty much anything that you use. If you type in Safe Money Retirement Radio, you'll find me. And it's a weekly podcast I put out there. They're very short. They're 10 to 12 minutes every single time. You're going to get a ton of information every week because I'm talking about this stuff that we just talked about. I'm talking about RMDs, talking about how you can get returns with no chances of losses. I'm talking about how you set up a guaranteed income you can't outlive no matter how long you live. I'm talking about all these things that are important once you hit retirement age. So you can get a ton of information. Like I said, it focuses all on stuff we were talking about. And as a certified financial fiduciary, like I said, I'm obligated to work solely on behalf of my clients and only in their best interest 100% of the time. So once again, my final piece of advice, I'm going to say it again, whether you work with me or someone else, I strongly, strongly recommend you work with a certified financial fiduciary for your retirement planning. Okay, I'm going to give it just a few more seconds because I see there's still a couple of people clicking on that click here to schedule. So if you're still waiting, if you want to do that, go ahead and do it right now. I'm going to hang out for just a couple more seconds before I have to close this. Just click there to schedule. And once again, just put in your name, your phone number, pick the time and date that you want to meet. We can do a phone call. I prefer Zoom because it makes it a lot easier to communicate. And if anybody else has any other questions I didn't answer, you can ask me questions right through my website. Once again, that is theplanadvisor.com. All right, I am going to go ahead and close this down. Thank everyone for showing up this evening. Hope I answered a lot of your questions. Hope to see all of you in your analysis. And those of you who requested the book, I will make sure I get it out to you. If you didn't get that request in, but you'd still like to get a copy of the book, go to my website or just send me an email. It's tim@theplanadvisor.com. Pretty simple. So just send me an email with your name and your shipping address. I'll get you a book out to you. Once again, tim@theplanadvisor.com. Or I can, of course, talk to you in your analysis. Have a great evening, everyone, and have a good retirement. Thanks. Take care. Bye-bye.